Hello friends, I'm Siddharth and today I'm going to talk about pure risk insurance, meaning term insurance, a term plan. You have seen our previous video on the traditional way of buying life insurance, wherein I had been discussing about my neighbor Mr. Sandeep and his endeavor to buy a life insurance policy, and in the end it is shown that he purchased a term insurance. So for those who have not seen that video, I have given that link in the description box. Please go through it. So continuing that video, continuing that concept of term plan, I will be explaining in this video the concept of term plan and its varieties. So what is a term plan? Let us understand. Basically, a term insurance or a pure risk insurance, it provides you the cover for a long term at very small cost, at very low cost, and yet the original idea, the main idea behind buying a pure risk insurance is to cover the risk of the policyholder dying too early. So if Sandeep dies too early before fulfilling his responsibilities, his major goals towards his families or his family's goals, needs and dreams, then his family gets a big sum of money. So as you have seen in that video, he purchased a term insurance of 1 CR. For next 25 years the plan will be covering him, and for which he will be paying an annual premium of rupees 10,000, and age is 30 years. So he must be believing, he must be calculating, actually he must have calculated that his major responsibilities will be over by the age of 55. So what if he dies before 55? Then there is a risk of his dreams not being fulfilled, or his major kind of responsibilities not being fulfilled towards his family. So that is what the term plan or pure risk insurance is meant for, to cover the risk of dying too early. So even if the event happens, then the family is not inconvenienced, at least in terms of money. So this is the concept of pure risk insurance. Now the textbook definition of term plan is, my friends, a term plan covers the policyholder until the term. So before the policy term expires, before the policy term ends, if the policyholder dies, only then the family gets the money. But if the policyholder dies after the term plan ends, then the family does not get the money. So if you go back to Sandeep's example, he took a plan for next 25 years and age is 30. So 30 plus 25 is equal to 55. So if he dies before 55, then his family gets the money. How much? 1 CR. But if he dies after 55, then his family does not get the money, because by that time his major responsibilities are over and the term of the plan is over. So that is how a pure risk plan runs. This is the concept of pure risk plan. And of course, one thing I forgot to tell you, this is the first variety of the term plan. How come? Because in this case, if the policyholder, Mr. Sandeep, he dies and his family gets 1 CR. So in this case 1 CR is what? A lump sum payout. In one shot, when you get the payout, that is called a lump sum payout. This is the first and the most common variety of the term plan, or otherwise known as the pure risk cover. Second variety, my friends, is a lump sum plus monthly payout within the term plan. So this essentially means that you can choose to buy a term plan, or for that matter Sandeep could have chosen to buy a term plan, but with the option of getting not only a lump sum payout but lump sum plus monthly payout to his family or to his nominee. So how come that works? Simple. If he dies before the age of 55, then his family will get a certain percentage, which in most cases is 90 to 95% in most of the policies in the market, of the sum assured. Plus the balance they will be getting equally spread over the next 10 years. So for example, if Sandeep dies at the age of 54, maybe, considering the fact that the policy is going to cover him until the age of 55, that is 25 years from now. So if he dies at the age of 50 or 54, then his family will get 95% of 1 CR in one shot, that is lump sum, plus balance is how much? 5 lakh rupees. That will be spread over equally over the 12 months for the next 10 years. So lump sum plus payout. This is the second type of term insurance plan. But remember, in this case, since you are asking for a higher benefits and that too for a longer period of time, so in this case premium will be a bit higher than the pure risk plan. That's the first variety. Third type of term plan is, my friends, that is with the return of premium. Most of the Indians, they treat life insurance as a savings tool, which actually it is not. But still, to appeal to the most of the Indians, this kind of taste or preference for returns within the policy, there is a variety of the term plan that is called the return of premium. So return of premium essentially means that if the policyholder dies within the term, of course the family will get the money, that is 1 CR, that is Sandeep dies within the time period. But what if Sandeep dies after the policy ends, that is he dies after the age of 55 years, then his family will not get the money? No, in this case his family will get the money. Rather, it will be correct for me to say that Sandeep will get whatever premium he has paid, he will get all those premium back. So he has paid a premium of 10,000 rupees per year for 25 years. So 10,000 into 25, that is 2.5 lakh rupees he will get back. Should he be surviving the policy? That is how the return of premium function in this case, in the case of a term plan. So these are the three varieties, my friends, of a term plan. Number 1 is the lump sum payout. Number 2 is the lump sum plus monthly payout. And number 3 is the return of premium. These are the three most common varieties. So choose your policy and the type wisely, my friends. And to help you with that, you can go to our application Credent Money, input your details, calculate your insurance cover, and buy the correct type of plan with the correct type of option. I hope you have understood my explanation. See you in the next videos. Thank you.